The interest rate cut cycle has returned. Indeed, with rate cuts, we're finally feeling some relief in our wallets. People who previously couldn't afford to get into the property market can now jump in. And investors can now more easily access financing to purchase one or two more properties. But the question is, where should we buy? How can we build a property portfolio that belongs to us and is sustainable in the long run? If we want to successfully build a property portfolio in Australia, we must understand the concept of the property market cycle clock. Each state's property market cycle is not synchronized. It's just like a clock. Some states are on the rise, some are declining, some are in a correction phase, and others are just beginning to recover. But is every state suitable for investment? And what are the unique characteristics of each city? Today, we'll break it all down step by step. We'll walk you through the Australian property cycle clock and show you how to ride each state's upswing and how to avoid investment traps. Hi everyone, I'm Alison from Australia. My channel focuses on Australian lifestyle, personal finance, and real estate. I'm one of the few licensed professionals in Australia who holds qualifications in both accounting and law while also working as a real estate agent. My team and I are committed to helping you build high-return, tax-efficient investment portfolios to fully protect your wealth. I'm also the author of Buying Property in Australia for Financial Freedom. Please note that everything I share here is based on personal opinion and does not constitute financial advice. If you're interested in one-on-one consultations, you can visit investwithalison.com and book a session that suits your schedule. According to the latest residential property survey by National Australia Bank, NAB, the National Confidence Index has jumped from +16 in Q4 last year to +40 in Q1 this year. This shows a significant improvement in market sentiment. But the performance across different states varies greatly. The Northern Territory has a confidence index of +100. South Australia is at +80. These two regions have the highest confidence levels, especially since their property markets are in strong growth phases. New South Wales is at +31, and Victoria is at +16. While these numbers have recovered from negative territory to positive, the confidence levels remain relatively low. In other words, these two markets are still in the early stages of recovery. Meanwhile, the Australian Capital Territory sits at -25, reflecting ongoing market weakness and limited buyer activity. Independent valuation firm Heron Todd White, HTW, publishes a property clock report every month, which identifies the market position for the top 50 regions across Australia. It helps you quickly see whether a particular area is rising, stable, or falling. In Australia, to build a successful property portfolio, we must understand the concept of the property market cycle clock. Each state operates on its own timeline, just like a clock. Some markets are rising, some are falling, some are in correction, and others are beginning to recover. Imagine the Australian property market cycle as a 12-hour clock. At 12 o'clock, the market is at its peak, with prices at their highest. At 3 o'clock, prices begin to fall. At 6 o'clock, the market hits bottom. At 9 o'clock, recovery begins and prices start to rise again. This cycle repeats continuously, and each state can be at a different point on the clock. A full cycle may take 5, 7, or even 10 years, depending on local supply and economic factors. Why is it so important to understand the property market cycle? Because your entry point directly affects your investment return. The best time to enter the property market is usually between 6 and 9 o'clock on the property clock. In other words, when the market has bottomed out or is starting to recover. This is the stage where buyers can enter at a relatively low price and ride the capital growth that follows. If we look at the latest report from April 2025, it shows where each city currently sits on the clock. Some cities are currently in the growth phase: Perth, Adelaide, Darwin, and the Gold Coast. Brisbane is at its peak. Sydney has entered a decline phase, while Melbourne is already in the midst of a downturn. Port Macquarie is approaching the bottom. Hobart and Geelong are at the bottom, while Canberra and Newcastle are just beginning their recovery. This report contains more detailed explanations. If you're interested, leave a comment and email us at marketing@rightkeyinvestment.com and we'll send it to you. This property clock model is actually quite accurate. On the ground, we're seeing strong price growth in cities like Perth, Adelaide, and Brisbane. Meanwhile, other cities like Melbourne, Sydney, and Hobart are in correction phases. To truly make use of the property cycle, there's one thing you must understand. No boom lasts forever. No matter how well a state is performing now, it will eventually go through a correction period. So how do we invest in a way that brings ongoing growth? The answer is build a cross-state investment portfolio. For example, even though I live in Melbourne, a city currently in a downturn, I also have investments in Perth and Brisbane, where the markets are still climbing. This allows me to refinance properties with increased equity and use that capital to purchase my next investment. The first benefit of a diversified portfolio is risk reduction. You never want to put all your eggs in one basket. If I had all my properties in Melbourne, I might be stuck in a flat or even declining market. On top of that, land tax here could become a heavy burden. Thankfully, I've always spread my investments across different states, and that's why my portfolio performed well last year. The second benefit is leveraging different strengths in different markets. For example, Sydney and Melbourne offer strong capital growth, but rental yields there are typically much lower. According to Domain, Sydney's average rental yield is about 3%, whereas Perth can achieve between 5%. That means you could get both strong rental income and capital growth in those cities. The third reason to diversify is to take advantage of different market cycles. You want to buy in the right city at the right time. Then, when that market rises, you refinance and reinvest that equity into another city that's at a lower point in its cycle. If you work with me to purchase property, aside from being a licensed agent, I'm also a qualified lawyer and accountant. That means I can help you calculate the numbers precisely so you can get the maximum return with minimum capital outlay, and we'll also make sure your holding costs are as low as possible. The fourth important reason to invest across different states in Australia is to save on land tax. In Australia, land tax is calculated separately by each state. This means every state has its own individual tax-free threshold and land tax rates. If you spread your property portfolio across multiple states, you can benefit from each state's tax-free threshold. In other words, if your properties are distributed across various states and each one stays under the local threshold, you can legally pay zero land tax. For example, if your total land value is 750,000 Australian dollars and all of it is in Tasmania, you would need to pay about $9,937 in land tax. If the same 750,000 Australian dollars worth of land is in Victoria and you're a local resident, the tax would be only $3,150. However, if you are a foreign investor and not residing in Australia, the land tax in Victoria for the same value would be 33,150 Australian dollars, more than the property's rental income in some cases. Now, if you split that 750,000 Australian dollars land value across multiple states, say $350,000 in New South Wales, $50,000 in Victoria, $150,000 in Western Australia, $100,000 in South Australia, and $100,000 in Queensland, you could take advantage of the tax-free thresholds in each state. As a result, your total annual land tax could be zero. That's why you should be cautious about the traps set by land tax and property agents. Avoid agents who only promote properties in a single state. Remember to work with professionals who understand and facilitate interstate investment strategies. For instance, I had a client who is a foreign investor and shared his unfortunate experience. Years ago, he bought a house in Brisbane through a local agent. At the time, land values weren't that high. But in recent years, Queensland property prices have surged. His property now has a land value of 600,000 Australian dollars. He then trusted the same agent again and bought a house and land package in Logan for 800,000 Australian dollars, with a land value of about 400,000 Australian dollars. So now, with two properties in Queensland totaling 1,000 Australian dollars in land value, as a foreigner, he's paying over $30,000 in land tax annually. That amount alone wipes out his rental income. For instance, the Logan property's annual rent is also just over $30,000, which all goes toward paying land tax. He questioned the agent's intentions and felt there was a conflict of interest. The agent never explained the risks of land tax for foreign buyers, nor that Queensland charges higher land tax for overseas owners. Because the agent only sold properties in Brisbane, he didn't advise the client to diversify across states, leading to this costly mistake. As a result, This client now has to pay more than 30,000 Australian dollars in land tax every year. Some people might question me and say, Alison, you live in Melbourne but sell properties in Brisbane and Perth. How can you possibly know those markets well enough? The truth is, my own investment portfolio is spread across different states in Australia. If you ask me where the nearest Hungry Jack's or 7-Eleven is to my Perth property, or where the nearest public toilet is to my Brisbane house, I honestly wouldn't know. Being familiar with a suburb on a street-by-street basis isn't necessarily helpful for investment. Knowing where a few fast food joints or convenience stores are doesn't significantly affect a property's investment value. My expertise doesn't lie in knowing every neighborhood's local spots. It's in doing thorough research to identify which states and suburbs have strong growth potential. As long as a suburb meets certain growth criteria, I don't need to know where the nearest public restroom or takeaway shop is. What matters is that there are shopping centers or retail hubs nearby to meet tenants' daily needs. That's enough. The specific locations? Google Maps can help with that. Many people think investing in property across states is hard, but I've seen numerous clients succeed with this strategy in recent years. Take Mr. Lee as an example. In 2020, he used 500,000 Australian dollars to buy a detached house in Queensland with a loan of $400,000. By 2022, the property value had increased by 40%, reaching 700,000 Australian dollars. After subtracting his outstanding loan balance, Mr. Lee was able to cash out $200,000. Then, Mr. Lee decided to use his 200,000 Australian dollars as a deposit to enter the booming Perth property market. At the time, leveraging Perth's hot market, he used the $200,000 to put down deposits on 2 standalone houses, each priced at 500,000 Australian dollars. That brought his total investment to 1 million Australian dollars, with a deposit of $100,000 for each property. By May 2025, property prices in Perth had increased by over 30%. As a result, the combined value of his 2 properties rose to 1.3 million Australian dollars. After accounting for his loan repayments, Mr. Lee was able to extract $250,000 in equity. At the same time, he also owned a standalone house in Brisbane, which appreciated by more than 20%, from 700,000 Australian dollars to $850,000. After deducting his repayments, he was able to extract another 200,000 Australian dollars in usable equity. This additional $200,000 can now be reinvested, like a snowball, compounding further. Mr. Lee is a textbook case of profiting from interstate property market cycles. Between Brisbane and Perth, he now owns 3 properties and has access to 450,000 Australian dollars in equity. He has since asked me to help him purchase 3 more Australian properties, each worth around 600,000 Australian dollars, to further expand his interstate portfolio. This refinancing and reinvestment strategy allows Mr. Lee to ride successive market waves, building momentum to enter the next growth market. His property holdings are growing like a snowball, larger with each roll. In just a few years, Mr. Lee's assets have grown significantly in value. His experience clearly shows that with the right strategy, building an interstate portfolio is not difficult. In fact, it's one of the best shortcuts to accelerate asset growth. Unfortunately, many new or less experienced investors tend to only invest in the state they are most familiar with. Some even limit themselves to just a few suburbs near their home. But that kind of thinking is outdated. Being overly cautious or stuck in a comfort zone only limits the potential of your property portfolio. By the time you're older, you may realize that seasoned investors around you have already capitalized on the growth cycles of various cities, doubling or even tripling their assets. Regret at that point would come too late. To fully ride the wave of Australia's interstate property boom, the first step is to broaden your perspective. Don't limit yourself to the cities you know. And don't only rely on property agents who only sell within one state. After all, no cat says no to fish. Agents will never tell you not to buy, especially if the only listings they have are in one state. Naturally, they'll encourage you to buy in that state because that's all they have to sell. If you, like them, lack knowledge of other state markets, you'll end up concentrating all your assets in one place. Let me say this again. No market stays hot forever. When the property cycle in one city turns downward, all your properties in that state could be affected. dramatically increasing your investment risk. Building a property portfolio requires breakthroughs, just like in life. You need to step out of your comfort zone. Learn the unique features and timing of other states' property markets. Time your entry right and build a truly diversified interstate portfolio. By spreading your risk across states, you can use each cycle's strengths to allocate capital more flexibly, seize each growth wave, and expand your portfolio in the shortest possible time. This strategy not only helps you grow faster, but also allows you to hedge against the ups and downs in any one location, leading to more stable and sustainable investment growth. If you're interested in investing or have questions, feel free to leave a comment below. If you'd like to book a one-on-one consultation, feel free to WhatsApp or email me, or visit my website at investwithalison.com to schedule a time. Thanks for your time, and I'll see you next time. Bye-bye.